Alphabet is valued at approximately $4.2 trillion. To justify that price, our reverse DCF says free cash flow must grow by approximately 21.5% per year, every year, for the next 10 years. That is more than the company has delivered in its recent history. Can Alphabet actually sustain that, or is the price already assuming perfection? To answer that, we test the valuation in 3 ways. A reverse DCF reveals what the current price already assumes. A traditional DCF estimates what the business could be worth under bear, base, and bull scenarios. An valuation multiple shows how expensive the stock is relative to earnings in its own history. 3 tests, 1 verdict. Before valuing Alphabet, we need to understand what actually produces the cash flow. Alphabet's engine is a flywheel. More users create more transactions, the platform keeps a take rate, and scale drops to the bottom line. The defense is the network effect. Buyers go where sellers go where buyers are, and both are already here. That also means the valuation depends on user growth and engagement have to keep compounding on an already large base, on whether the take rate has to rise gently without pushing activity off the platform, and on whether infrastructure and content costs have to grow slower than revenue. Alphabet's recent performance explains why investors pay the current price. Over the last 3 years, revenue has grown at approximately 12.5% per year, earnings per share at approximately 33.3%, and free cash flow at approximately 6.9%. Over the same period, free cash flow margins have moved from 21.2% to approximately 18.2%. The most recent quarter adds nuance. Revenue grew 21.8% year over year, a clear acceleration from its recent trend. The question is whether that continues. You can see it on the chart. While the broader market compounded quietly, the stock ran far ahead of it. That run is the reason for the premium. But recent growth is the starting point of this analysis, not the forecast. The question is never what was delivered, it is what the price now requires. At the time of this analysis, Alphabet trades at approximately $347 per share for an equity value of roughly $4.2 trillion. Trailing free cash flow is approximately $64 billion. A traditional DCF starts with forecasts and calculates a value. A reverse DCF does the opposite. It starts with the current market value and solves for the growth rate that makes the price mathematically possible. We use a discount rate of 9%, terminal growth of 2.5%, and the company's current free cash flow base. The result, the market is pricing in approximately 21.5% annual free cash flow growth over the next 10 years. That growth path takes free cash flow from $64 billion today to approximately $451 billion in year 10, 7 times the current level. Watch it compound, year by year. Year 1 already needs roughly $78 billion. By year 5, approximately $170 billion. And by year 10, $451 billion. Each year building on the last with no year off. That target has operational consequences. At a long-term free cash flow margin of 18.2%, Alphabet would need approximately $2.5 trillion in annual revenue by year 10. The market is not pricing in one more strong year. It is pricing in 10 years of sustained delivery. But does our own forecast produce the same value? The reverse DCF tells us what the market requires. Our traditional DCF tests whether a reasonable forecast produces a similar value. In the base case, revenue growth begins at approximately 10.3% and fades gradually toward 4% as the company becomes larger. We assume a mature free cash flow margin of approximately 18.2%, a discount rate of 9%, and terminal growth of 2.5%. Under these assumptions, our base case value is approximately $121 per share. In the bear case, growth fades early toward 5.6% and margins come under pressure. That is worth approximately $87. And in the bull case, 13.9% growth, with almost everything going right, the value reaches approximately $154. Bear, base, bull. That is our honest range. Now watch where the current price lands. With the stock at $347, the price sits above even our bull case. The DCF gives us a value. The multiple tells us what investors are paying for it right now. Our final test is the valuation multiple. Alphabet trades at approximately 26 times trailing earnings. Based on expected forward earnings, that falls to approximately 24 times. The gap reflects the growth analysts already expect. The company's own 5-year median is approximately 24 times. The broader market trades at approximately 24 times. Think of a multiple as patience, 26 times of price for every unit of current earnings. A high multiple is not automatic evidence of overvaluation. The question is whether earnings can grow fast enough to justify it, and that is exactly what the DCF already measured. The valuation survives mathematically, but only if a few conditions keep holding. So what has to go right? First, user growth and engagement have to keep compounding on an already large base. Second, the take rate has to rise gently without pushing activity off the platform. Third, infrastructure and content costs have to grow slower than revenue. And finally, Alphabet must execute consistently. The current valuation does not depend on one strong quarter. It depends on repeated delivery, year after year. Picture 10 boxes, one for each year. The price has already checked every one of them in advance. The company still has to earn the check marks. The valuation can fail in several ways. Attention migrates. A platform that loses cultural relevance loses growth first, revenue second. Push the take rate too far and the ecosystem routes around you. The margin path assumes the ceiling is far away. Platform regulation raises costs and can cap monetization, a structural, not cyclical drag. And higher interest rates would reduce the present value of distant cash flows, even if the business itself keeps performing. These risks do not need to destroy the business. They only need to produce results below what the current price already requires. Alphabet passes some of these tests. The final question is whether it passes all three. Three tests. Here's the verdict. Test 1, the reverse DCF. The price demands 21.5% growth every year for 10 years. Growth well above what the company recently delivered. Test 2, our own DCF. $87 in the bear case, $121 in the base case, $154 in the bull case, and the current price sits above even our bull case. Test 3, the multiple. A clear premium to its own 5-year median. Add the three together and the pattern is hard to ignore. Even our most optimistic scenario cannot reach today's price. Our base case sits roughly 65.2% below it. One test flagging a stock can be noise. 3 tests pointing the same way is a message. This price already contains a nearly flawless decade. Our overall verdict, priced beyond our bull case. Alphabet remains the most dominant advertising and search engine franchise ever built. But a great business is not automatically a great investment at every price. This analysis is a valuation framework, not financial advice. The result depends on the assumptions shown, and you should always verify them and do your own research.